War risk insurance. It sounds niche until you realize it's quietly reshaping the price of every barrel that moves by sea in 2026. Here's the shock. Since the conflict escalations, war risk premiums on key routes have spiked 400% or more. That's not a rounding error. That's hundreds of thousands of dollars per voyage just to sail through a hotspot. Quick primer. Standard hull and P&I coverage exclude war. Red Sea parts of the Black Sea choke points flagged by the Lloyd's Joint War Committee. You need separate war risk cover. It's underwritten in the Lloyd's of London market. Syndicates, brokers, reinsurers pricing risk sometimes daily, sometimes per transit. Rates used to be tiny. Think 0.002%, 0.05% of a ship's hull value for a 7-day touch in a listed zone. Today, 0.25% to 0.5% isn't unusual when missiles and drones enter the chat. On a $100 million tanker, that's jumping from maybe $20-50K to $250-500K for one pass. Add in crew bonuses, security detours, and the math gets brutal. Now the split. Small tanker owners. If I'm a small owner with 2 or 3 ships on the spot market, I pay cash up front, voyage by voyage. A surprise listing by the Joint War Committee and my premiums repriced overnight. I fight to pass it through via a war risk additional premium clause, but charterers push back on short notice or demand discounts. My bank wants proof of cover, my reinsurer tightens terms, and my cash flow gets chewed up by deductibles and higher limits. One bad week can erase my month. If I'm an oil major or a large fleet with scale, it's different. I might have a captive insurer, multi-voyage facilities at Lloyd's, and brokers who place layered programs with better limits and lower loadings. I hedge routes weeks ahead, lock in options on cover, and bundle dozens of voyages to dilute the spikes. If rates explode, I can reroute around the Cape, absorb the extra days, and still honor term contracts. I also negotiate wrap pass-throughs hard, and on time charters, I'm controlling the cost either way. Behind the scenes, reinsurers have pulled back capacity or raised prices, so Lloyd's syndicates price tighter and move fast when a drone strike hits the news. Compliance adds friction. Sanction screens OFAC checks because one wrong call and coverage is void. The result? A hidden tax on risk that punishes the smallest players most, nudges flows away from conflict zones, and quietly lifts delivered oil prices. War risk insurance isn't just a line item, it's the lever moving tankers' routes and margins in 2026. So the next time crude shifts $1, remember, it might not be demand. It might be the cost of sailing through a war zone, priced on Lime Street in London.